Hey everyone, welcome to The Explainer. I am absolutely thrilled you're joining me today because, well, we are setting the stage for an absolutely epic financial showdown. We're looking at two vastly different assets that represent the ultimate clash of generations, philosophies, and wealth building strategies. On one side, we have the undisputed heavyweight of history, and on the other, the disruptor of the digital age. Picture this for a second. You wake up tomorrow to discover that your entire life savings have suddenly doubled. Sounds incredible, right? But now imagine the exact opposite. You wake up to find those very same savings have been cut in half overnight. That right there represents the extreme stakes of modern investing. For thousands of years, one physical asset has been the trusted bedrock for kings and governments alike. But over the last decade or so, a 15-year-old digital challenger has emerged, and its supporters actually believe it could replace the old guard forever. So which one deserves your attention, and more importantly, your money? Okay, let's dive into this. Consider this our tail of the tape matchup card for tonight's explainer. 1. The reigning champion, gold. 2. The digital challenger, Bitcoin. 3. A head-to-head asset comparison. 4. Understanding the investment risks. And 5. The final verdict. Section 1. The reigning champion, gold. Just look at that number, 5,000. For over 5 millennia, gold has been trusted and utilized as money and a deeply reliable store of wealth. This isn't just some passing trend, guys. This is 5,000 years of trust established by kings, empires, governments, and everyday investors all across the globe. So, why does it actually endure? Honestly, it really comes down to physics. Gold is rare, it's incredibly durable, and it's literally impossible for governments to artificially print out of thin air. That absolute physical limitation is exactly why central banks still hoard it today to strengthen their own financial standing. Plus, whenever inflation rears its ugly head or global uncertainty spikes, investors just flock to it as the ultimate safe haven. It has literally survived world wars, massive financial crises, and total economic collapses. That unparalleled, deep-rooted history gives investors the confidence that it's always going to hold its value. Section 2. The digital challenger, Bitcoin. And this brilliantly illustrates exactly why it commands so much attention. 21 million. That is the absolute maximum number of Bitcoins that will ever exist. Unlike traditional fiat money, no government or central bank controls it, and no one can arbitrarily increase its supply. This mathematically engineered absolute scarcity is the very reason its most ardent supporters refer to Bitcoin as digital gold. But beyond just scarcity, Bitcoin completely removes the middleman. It allows for global wealth transfers entirely outside the grip of governments or traditional banks. By operating on a decentralized network, it empowers everyday people to bypass the traditional banking system entirely. For investors, this lack of central control and the sheer ability to move money frictionlessly across borders gives Bitcoin massive growth potential as global adoption continues to ramp up. Let's move to Section 3 and see how this builds into our head-to-head asset comparison. So the crucial point is how these heavyweights stack up across the metrics that actually matter to your portfolio. The battle basically breaks down across 5 critical fronts: stability, growth, inflation, accessibility, and security. Let's impartially unpack exactly where the ancient metal and the digital code diverge. First up, we're looking at the trade-off between stability and growth. Gold is, generally speaking, far more stable. Its price changes slowly, methodically, and very gradually over time, which deeply appeals to more risk-averse investors. Bitcoin, on the flip side, is notorious for extreme daily swings. It can rise or fall dramatically within a single 24-hour period. But that volatility is a double-edged sword. While gold grows gradually, Bitcoin has delivered absolutely extraordinary historical returns during certain periods. It's the classic battle, right? Lower risk with steady stability versus higher risk for massive growth potential. Next, let's compare them as shields for your purchasing power, specifically protection against inflation. Both assets are frequently viewed as hedges against inflation, but the evidence behind them is vastly different. Gold brings centuries of indisputable proof supporting its role as an inflation hedge. Bitcoin, well, it's much newer. While its fixed supply theoretically suggests it should protect against inflation perfectly, its long-term performance across a wide variety of different economic conditions is still actively being studied and debated by economists right now. Now, when it comes to actually owning these assets, accessibility and security present completely different challenges. Buying Bitcoin is incredibly frictionless. You can literally do it online in a matter of minutes. But that digital convenience comes with a severe security risk. If you lose access to your digital wallet or you forget your private keys, you can permanently lose your funds. There is no customer service hotline to call. Gold, conversely, can be purchased physically, but securing it requires serious logistical planning to protect against physical theft. Both demand highly responsible but entirely different security measures.
Section 4. Understanding the investment risks.
It is absolutely crucial we take a sobering reality check here. No investment on Earth is entirely safe or risk-free. And honestly, investing without fully understanding the downsides of these assets can lead to significant financial losses. The risks are very real on both sides. For gold, your primary enemy is opportunity cost. Prices can sometimes remain completely flat for years at a time, meaning your wealth just isn't growing while the rest of the market might be taking off. For Bitcoin, the risks are far more aggressive. It is highly volatile, subject to sharp, sudden, and, frankly, terrifying price drops. Furthermore, because it operates entirely outside the traditional system, it is highly vulnerable to new, restrictive government regulations affecting cryptocurrency markets. You absolutely must research thoroughly before exposing your savings to either of these realities.
Section 5. The final verdict.
Now, what's really interesting about this is how financial experts actually synthesize these immense pros and cons into a coherent strategy. Here's the ultimate takeaway. Top financial professionals don't view this as a zero-sum cage match. In fact, they strongly suggest diversification. Relying entirely on a single asset exposes you to totally unnecessary risk, whereas combining them allows the steady stability of one to hedge against the wild volatility of the other. Ultimately, it's a question of preservation versus potential. The choice connects directly back to your personal financial goals and your own risk tolerance. If your main priority is wealth preservation and just sleeping soundly at night knowing your value is stable, gold has a long-established, multi-millennium reputation for sure. But if you're comfortable stomaching higher risk in exchange for potentially higher rewards and the massive upside potential of digital adoption, Bitcoin is going to strongly appeal to you.
So, gold or Bitcoin? As we wrap up this explainer, I'm handing the final decision over to you. Taking into account the history, the technology, the stability, and the volatility, what would you choose? Gold, Bitcoin, or perhaps a careful, strategic mix of both? Remember, past performance does not guarantee future results. I really want you to share your opinion in the comments below and explain your reasoning. If you enjoyed this deep dive and want more explainers on wealth building strategies, make sure you like, subscribe to the channel, and turn on those notifications so you never miss an upload. Thanks so much for learning with me today, and I'll see you in the next explainer.